try and make sense of a behemoth like Exxon Mobil, it can feel like you're just lost in this maze of information.
It's
Right?
overwhelming sometimes. So much data, so many reports.
Exactly. That's where we come in. Welcome to the Deep Dive, your shortcut to getting, well, the crucial insights.
And today, we're tackling Exxon Mobil head-on.
We're drilling down using a recent research report from CompaScope,
Yeah.
and also looking at their first quarter 2025 earnings call.
So what's the mission for today? What are we trying to figure out?
Okay, the mission is clear. Understand the nuts and bolts of their business, how they stack up against rivals, their growth plans.
The potential risks too, presumably?
Oh, absolutely, the bumps in the road.
Yeah.
And what their recent performance tells us. By the end of this, you should have a much clearer picture of what really matters with XOM.
All right. Sounds like a plan. So where do we start? The business itself.
Let's do that. What exactly does Exxon Mobil do? It's a huge operation.
It is, but we can break it down. Think of it in maybe 4 key areas.
Yeah.
Makes it easier to grasp.
Okay, 4 areas. What's first?
First up is the upstream business.
Right. This is the classic oil and gas stuff, isn't it? Exploration, production.
Exactly. Finding it, getting it out of the ground, crude oil, natural gas.
And where are they doing this mainly?
Key spots are the Permian Basin, that's a big one in the U.S., also Guyana, that's been huge for them, plus global offshore, deep water operations.
And LNG, I know that's a growing area.
Definitely. They've got significant liquefied natural gas projects. Think Mozambique, Papua New Guinea, and the Golden Pass project on the U.S. Gulf Coast.
Okay, so that's upstream. What's number 2?
Then you have the downstream business. They actually call it product solutions now.
Product solutions. So this is taking the crude and turning it into, well, stuff we use.
Precisely. Refining it into gasoline, diesel, aviation fuel, the transportation fuels.
But it's more than just fuel, isn't it?
Oh, yeah. Specialty products, too. Lubricants, additives, base stocks, even those lower emission fuels we're starting to hear more about.
And they handle getting it to market. Retail, wholesale.
Yep, the whole distribution chain.
Got it. Okay, area 3.
The chemical business. This is pretty significant for them.
Manufacturing chemicals, like
Yeah.
the basic building blocks.
That's part of it. Basic petrochemicals, ethylene, propylene, things like that. But also what they call performance chemicals.
Performance chemicals, what does that mean?
Think advanced polymers, specialized plastics, stuff used in more demanding applications. Polyethylene, polypropylene are examples.
Interesting. And I saw something about recycling.
Yes, they highlight their advanced recycling efforts, trying to create circular polymers, tackle plastic waste. That's becoming a bigger focus.
Okay, upstream, downstream product solutions, chemicals. What's the 4th leg?
The final piece is the low carbon solutions business. This is newer, obviously, but growing in focus.
The energy transition part of the business.
Right. This covers things like developing carbon capture and storage CCS systems.
Capturing CO2 emissions, basically.
Exactly. Also investing in low-emission hydrogen production and working on renewable fuels, advanced materials. It's a mix of future-facing tech.
So if you had to summarize those 4 into bigger buckets, the CompaScope report did that, didn't it?
Yeah, they grouped it nicely, basically. Hydrocarbon operations, chemical and specialty products, and then this developing area of low-carbon transition.
Makes sense. Okay, so that's what they do, how they stack up against the competition. That's always crucial.
Absolutely. You need to understand their strengths and weaknesses relative to their peers. What makes them competitive?
Okay, let's dig into ExxonMobil's competitive advantages, according to CompaScope. First thing they mention is the integrated model.
Ah, yes, the integration. How significant is that?
Well, they point out that about 80% of their refining is actually integrated, linked directly with their chemical manufacturing.
And the benefit of that is?
CompaScope suggests it leads to higher profit margins and better capital efficiency, using their assets more effectively.
That makes sense. That synergy between refining and chemicals isn't something all competitors have to the same degree.
No, seems like a key differentiator.
Yeah.
Next up, their high-quality asset portfolio.
This must be about places like the Permian and Guyana, right?
Exactly. The report focuses on those high-margin, low-cost assets. They reckon these can deliver solid returns, even if oil drops quite low, like $35 a barrel.
Wow, $35. That's a strong buffer against price swings. That low cost of supply is a huge advantage.
Definitely gives them resilience. Then there's their disciplined investment strategy, especially regarding low carbon.
Disciplined how? What are they spending?
Relatively modest, actually. About $30 billion committed through 2030 for low carbon. The key thing is their focus seems to be squarely on return on capital employed, ROCE, and shareholder value.
So they're not throwing money at everything low carbon, just the projects they think will provide strong returns.
That seems to be the approach, which, as you said, is disciplined but raises questions about whether it's enough for the long-term transition.
It's a trade-off, I suppose. Less risk now, maybe more later.
Could be. They've also made big strides in operational efficiency.
Cost-cutting.
Yeah, the report mentions $12 billion in structural cost reductions since 2019. That's quite a bit.
12 billion. That definitely helps the bottom line and makes them leaner. Shows a real focus.
And finally, CompaScope highlights their leadership in downstream and chemicals.
So in those refining and chemical segments, they're performing well.
Apparently so. Consistently strong ROCE, and they keep investing in those higher margin products. They're not just participating, they're leading in profitability there.
Okay, so integration, quality assets, disciplined spending, efficiency, and downstream strength. Sounds pretty solid.
It does, but like any company, they face challenges too, right? CompaScope points these out as well.
Of course, nothing's ever perfect. What are the main ones?
First is the obvious one, commodity price dependence. Their fortunes are still heavily tied to oil and gas prices.
Yep, the classic risk for any energy producer. Volatility and also long-term demand shifts, EVs, the transition.
Exactly. Which leads to the next challenge, limited renewable energy exposure.
So compared to some European majors like Shell or BP, their renewables footprint is smaller.
Seems so. CompaScope suggests this could potentially impact their long-term competitiveness if the shift to renewables happens faster.
It's that future-proofing question again. Are they positioned for a very different energy mix down the road?
Another one is geopolitical risk exposure. They operate globally.
Right. Some regions are less stable than others. That always carries risk. Political changes, disruptions.
And lastly, ESG litigation and carbon footprint. This seems to be a growing issue.
ESG, environmental, social, governance. So lawsuits related to climate and their emissions.
Yeah, challenges around climate disclosures and their upstream operations apparently have a relatively high greenhouse gas intensity compared to some peers. Investors are watching that closely.
Definitely. ESG pressure isn't going away.
Okay, so how do they compare directly to the competition then? CompaScope looked at that.
They did. Let's take Chevron, CVX first. Strengths are cost control, Permian efficiency. Okay, good operators, weaknesses.
Less chemical integration than Exxon, apparently, and not as strong in those high-value downstream products.
So strong in production, maybe less so in the integrated value chain compared to Exxon.
Seems that way.
Yeah.
Then Shell, as you show. Their big story is the aggressive energy transition push, right? Big renewable investments.
Yeah, they're really pivoting. But what's the downside, according to the report?
Near-term profitability might be taking a hit, and their integration and downstream performance aren't seen as strong as Exxon's.
So Shell's making a big bet on the future, but it comes with present-day costs and challenges.
Makes sense. How about BP? BP, also pushing hard on renewables.
Very much so, aiming to significantly cut oil and gas production. Big shift.
And the challenge there.
Balancing that decline in traditional revenues with actually scaling up renewables successfully. Plus, their downstream margins are reportedly weaker than Exxon's, a riskier path maybe, needing those renewable investments to really pay off.
Potentially. Finally, TotalEnergies, TTE, their approach.
More balanced, it seems, investing in both LNG and renewables, while keeping an eye on capital efficiency.
Sounds reasonable. Any weaknesses?
Potential risks with executing new renewable projects, and they're quite reliant on global LNG demand staying strong.
Gotcha. So summing up that competitive landscape, what's CompaScope's overall take?
Their conclusion is that Exxon Mobil has a more defensible competitive advantage.
Why? What's the core reason?
It comes down to that integration, their strong downstream and chemicals businesses, and that disciplined focus on profitable hydrocarbons. They see it as a more solid foundation right now.
Interesting contrast. Exxon sticking to its strengths while some others make bigger, maybe riskier bets on the transition.
Exactly. Different strategies for navigating the future.
All right, let's switch gears then and talk about ExxonMobil's growth strategy. Where are they planning to grow? CompaScope breaks it down.
Yeah, they outlined 3 main pillars for growth.
Okay, pillar number 1.
Unsurprisingly, it's hydrocarbon expansion. They're not shrinking production, they're aiming to grow it.
Grow it. By how much?
From about 4.3 million barrels of oil equivalent per day in 2024 up to 5.4 million by 2030. That's a pretty significant jump.
Wow, okay. And where's that growth coming from?
Key drivers are, again, the Permian. They expect that to hit 2.3 million barrels a day by 2030, and that includes the Pioneer acquisition integration.
Right, that was a big deal.
Huge. Then Guyana, they're targeting 8 FPSOs, those floating production units. By 2030, that means 1.7 million barrels per day of gross capacity there.
8 FPSOs. That's massive investment.
It is, and also growth from their LNG projects we mentioned earlier.
So near-term growth is still very much anchored in oil and gas, particularly those high-return assets.
It's absolutely. That's the engine for now.
Okay, pillar 2.
Downstream and chemicals enhancement.
So getting more value out of the hydrocarbons they produce.
Essentially, yes. Investing in projects for higher value products, specialty chemicals, lubricants, those circular polymers, performance chemicals.
And they put a number on that.
They're projecting about $8 billion in earnings growth from these areas by 2030.
$8 billion just from downstream and chemicals growth.
Okay.
And the third pillar.
That's the nascent low-carbon technologies.
Nascent meaning still early days, selective investments.
Exactly. That $30 billion through 2030 we mentioned, it's focused returns oriented.
And focused on what specifically? CCS, hydrogen.
Those are key areas. Carbon capture and storage, low-emission hydrogen, advanced plastics recycling, and low-emission fuels.
Is there an earnings target for this pillar?
They project maybe $3 billion in earnings by 2030, but, and this is important, it's conditional. Depends on market development and policy support.
Right, so it's not a guaranteed $3 billion. Depends on external factors.
Very much so. Their approach here is clearly more cautious, more opportunistic than some peers.
So Compass Scope emphasizes this balanced approach, right? Prioritizing profitable hydrocarbons while gradually building out low carbon.
That's the core message. Reliable returns now while positioning carefully for the future.
And we already touched on how this compares to peers Chevron, also hydrocarbon focused, Shell and BP, much more aggressive on renewables, TotalEnergies trying to balance LNG and renewables.
Yeah, the strategic differences are quite stark when you lay them out like that. Exxon's path is definitely more evolutionary than revolutionary compared to some.
Let's talk revenue and profit potential of this strategy. Compass Scope sees it anchored where?
Anchored firmly in those short cycle, high margin hydrocarbons, particularly Permian and Guyana. That's the near term cash cow.
Plus reliable midterm revenue
From those higher margin downstream and chemical products they're enhancing.
And the low carbon piece, while smaller now, offers
Strategic positioning, particularly in CCS and hydrogen, that potential $3 billion by 2030 if things align.
So overall, what's the potential profit growth?
They talk about a potential $20 billion in upstream downstream profit growth and maybe $30 billion in cash flow by 2030. Big numbers.
Very big. How achievable do they think this strategy is?
Compass Scope seems fairly positive on achievability. They point to Exxon's strong project execution track record, delivering complex projects on time, on budget.
Like in Guyana.
Exactly. Plus, the capital discipline helps. And that selective approach to low carbon limits the risk compared to going all in.
And integrating acquisitions like Pioneer, improving efficiency, that helps too.
All supports profitability and makes the target seem more reachable.
But there are always risks. We talked about commodity prices.
Yep, that's a major one. And the long-term oil demand question. Regulatory risks around decarbonization are huge, too.
And policy uncertainty in the low-carbon space, that conditionality you mentioned.
Right. If government support for CCS or hydrogen doesn't materialize as hoped, that $3 billion target gets shaky.
So despite the risks, Compass Scope's bottom line on the growth strategy is?
They see it as having stronger long-term prospects compared to many peers.
Why stronger?
Because the revenue and profit potential seems more achievable, anchored in those core strengths, and the energy transition part, while slower, is seen as more measured and perhaps less risky than some of the faster pivots.
Okay, strategy looks achievable, but execution risk is always a factor. How well can they actually implement these plans?
Crucial question. Compass Scope looked at this closely. First, they note Exxon's strong operational track record.
Delivering those big projects.
Yeah, consistently delivering large-scale projects like in Guyana, often ahead of schedule, under budget, plus successfully integrating acquisitions like Pioneer. That builds confidence.
And their integrated model helps with execution too.
Provides flexibility, resilience, helps them navigate volatility across the business.
What about those geographical and political risks? Does that add to execution risk?
It does create exposure, certainly. But Compass Scope feels their deep experience and diversified portfolio help mitigate it somewhat. Still, operating in places like Guyana or Mozambique isn't without challenges.
And the fact that their strategy is still hydrocarbon dominant, How does that affect execution risk?
Well, it limits risk in sectors they know extremely well. The flip side is it potentially reduces their buffer or adaptability if the energy transition accelerates really rapidly.
Makes sense. Less risk in the known, maybe more risk related to the unknown speed of change.
Exactly. And then there are specific low-carbon growth risks.
Tied to market development and policy again.
Precisely. Success there depends heavily on external factors developing favorably for CCS and hydrogen. Their measured approach limits the investment risk upfront, but the market risk remains.
Okay, so how does Exxon's execution risk profile compare to peers?
CompassGov sees Chevron as having solid upstream execution, but maybe some added risk with the complexities of their big Tengiz project.
And Shell and BP, higher risk.
Yes, perceived as higher risk because they're pivoting more aggressively into less proven renewable markets. That's a bigger execution challenge.
BP especially, with its plan to shrink oil and gas significantly while scaling renewables.
Right. And TotalEnergies is seen as moderate risk-balanced approach, but maybe higher exposure to geopolitics and renewable scalability issues than Exxon.
So the takeaway on execution risk.
CompassGov believes Exxon Mobil exhibits lower business execution risk compared to peers like Shell and BP.
Primarily because?
Because of their proven hydrocarbon model, their track record on project delivery, and what's seen as more manageable geopolitical exposure compared to some others undertaking bigger transformations.
Their more deliberate approach seems to translate into lower perceived execution risk.
That appears to be the assessment, yes,
Yeah.
sticking closer to their core competencies.
Okay, let's shift now to more recent events. What are the recent business updates and business trends coming out of their Q1 2025 earnings call?
Right. So the call provides a snapshot of current performance and thinking. CEO Darren Woods kicked things off acknowledging market uncertainty.
Uncertainty like.
Things like tariffs, questions around OPEC supply intentions, maybe slower economic growth putting downward pressure on prices and margins.
So acknowledging headwinds. But his message was positive overall.
Yes, he emphasized their preparedness, citing the work done over the past 8 years. He focused on what they can control.
Which is?
Their advantaged portfolio, low cost of supply. Their strong balance sheet highlighted a low 7% net debt to capital ratio. And that lean cost base mentioning $12.7 billion in structural cost cuts since 2019.
So stressing resilience. How are the Q1 numbers?
Pretty strong. $7.7 billion in earnings, which was up sequentially if you exclude certain items, and $13 billion in cash flow from operations.
Solid performance. They mentioned asset sales. They've been doing that steadily.
They did. Another $1.8 billion in asset sales in Q1. That completed a $5 billion incremental divestment target they had, brings the total since 2019 to $24 billion in non-core asset sales.
Oh, $24 billion. Really reshaping the portfolio.
Definitely focusing on higher value assets. Woods also said these moves have boosted their underlying quarterly earnings power by about $4 billion since 2019 at current prices.
And they're still pushing to lower their break-even point.
Yep. Targeting $35 per barrel by 2027 and aiming for $30 by 2030. Continuous drive for efficiency.
Any updates on major projects starting up?
Yes. Highlighted the big chemical plant in China starting operations ahead of schedule, under budget. That's a good sign for execution.
Well,
The second advanced recycling unit at Baytown also started up, and they expect 2 new FPSOs, one in Guyana, one in Brazil, to start later in 2025.
so new production coming online soon.
Exactly. He also gave an update on their Proxima business, that's the advanced materials unit.
Oh, right, for EV batteries and wind turbines.
Yeah, things like high-strength materials for EV battery cases, collaboration on wind turbine blades. They're actually doubling production capacity there this year.
Interesting diversification, even if it's small scale for now.
It is. And Woods noted that the 10 Advantage projects starting up this year are expected to generate over $3 billion in earnings in 2026.
Advantage meaning low cost, high margin.
Presumably, yes. Projects expected to deliver strong returns quickly.
What about shareholder returns? Still a priority.
Absolutely. Unchanged capital allocation priorities.
Yeah.
Profitable growth, strong finances, shareholder returns. They distributed $9.1 billion in Q1.
How much of that was buybacks?
$4.8 billion in share repurchases. He noted they've now bought back about a third of the shares they issued for the Pioneer acquisition.
Okay, actively returning capital. Anything else stand out from the call?
One interesting point Woods made. 0 shareholder proposals in their 2025 proxy. First time since 1958.
0. That's unusual for a company this size. Why?
He attributed it to their strong performance and their willingness to, as he put it, challenge actions that undermine shareholder value. Maybe also indicates broad investor satisfaction currently.
Did he mention any legal issues?
Briefly touched on the ongoing litigation against the EU windfall tax and some issues with the California Attorney General. Also mentioned publishing their latest climate report and a new company overview.
Okay. And broader business trends discussed. We mentioned market uncertainty.
Right. Impact of tariffs, potential OPEC supply increases, putting downward pressure on prices, but also stressed long-term robust fundamentals for energy and chemicals.
So near-term caution, long-term confidence.
Seems like it. In chemicals, acknowledging industry oversupply but focusing on low-cost supply and high-value products, maintaining flexibility in upstream investment depending on market conditions.
Still driving cost savings.
Yes, driven by their centralized organization and using technology.
What about low carbon updates from the call?
Mentions CCS as the largest low-carbon investment focus for 2025, with their first customer expected to come online soon. Still very enthusiastic about the Permian, especially using new tech like low-weight proppant, and highlighted strong performance in refining due to operational improvements.
So generally a message of steady execution, managing costs, focusing on advantaged assets, and navigating near-term uncertainties.
That sums it up pretty well, confident in their strategy.
Okay, this brings us to the final section. What should we, and you, the listener, be watching going forward? The keys to watch. CompassScope actually ranked these, didn't they?
They did, which is helpful. Top of their list, number 1, global energy transition and decarbonization policies.
Makes sense. The pace of change, EV adoption, ESG pressure that shapes everything.
Absolutely. It affects demand, regulation, investment, the whole landscape. Number 2 is the oil and gas pricing environment.
Still fundamental to their bottom line. OPEC plus decisions, geopolitics, economic growth.
Exactly. Price volatility is always key. Third on the list, execution risks in strategic growth projects.
Can they deliver those big projects in Guyana, the chemical plants, etc., on time and on budget?
Crucial for hitting those growth targets. Delays or cost overruns would hurt. Fourth is performance and market adoption of low-carbon solutions.
Will CCS and hydrogen take off? Will the policies be supportive? That conditional $3 billion earnings depends on this.
Big question mark there. Fifth, the regulatory and legal landscape.
Environmental rules, emission standards, those ongoing legal battles, potential financial impacts.
Significant risks there. 6, geopolitical risks in key operating regions.
Stability in places like Guyana, Mozambique. Disruptions could impact operations directly.
A constant factor for global operators. 7th, chemical and refining margin recovery.
Can those downstream margins hold up if there's oversupply or weak demand?
Important for that segment's profitability. 8th, inflationary pressures and supply chain dynamics.
Rising costs for materials, labor, equipment. Can they manage those effectively?
Impacts project costs and overall margins. 9th, global LNG market dynamics.
They're investing heavily in LNG. Need demand to stay strong and avoid oversupply.
Their LNG bets need that market support. 10th, competitive landscape in emerging low-carbon markets.
As they dip their toes into CCS and hydrogen, how will they fare against more aggressive competitors?
Can they carve out a profitable niche? 11th, global economic growth and energy demand.
A major global slowdown would obviously hit overall energy consumption.
Basic macroeconomics. 12th, investor sentiment and debt position.
Keeping investors happy, maintaining that strong balance sheet, crucial for access to capital.
And managing debt prudently. Finally, 13th, permitting and environmental constraints.
Getting approvals for new projects, dealing with environmental opposition, can hinder growth plans.
Always a hurdle in this industry.
Okay, that's quite a list. So wrapping this all up, this deep dive using CompassScope in the earnings call really paints a picture, doesn't it?
It does. You see a company with this deeply integrated model, clear competitive strengths in efficiency and assets.
And a growth strategy that's, well, deliberately balancing its huge hydrocarbon base with a more cautious, measured step into low carbon.
Execution seems key for them, navigating this dynamic market, and we've laid out those critical factors to keep an eye on.
It really leaves you with a provocative thought, I think. How will this specific strategic positioning, emphasizing core strengths, a measured transition, play out for Exxon Mobil in the long run?
Especially in a world that seems to be accelerating its focus on sustainability and decarbonization. Will their path prove more resilient, or will they find themselves needing to adapt more quickly down the line?
It's the central tension, isn't it? balancing today's profitability with tomorrow's energy landscape. Definitely something for you, the listener, to consider as you do your own research.
Absolutely. Hopefully this deep dive provided a solid foundation for that.
We hope so. Thanks for joining us for this deep dive into Exxon Mobil.
This content is produced by Compasscope.com. For more than 1,100 public listed companies, find detailed research reports, visual mind maps, earnings call analysis, and audio discussions on Compasscope.com.